Have you ever parked at a grocery store and noticed a row of brand new trucks and SUVs that look like they belong in a commercial? Big wheels, spotless paint, fresh plates, the kind of interior that smells like new leather and expensive decisions. Then you walk inside, see the price of eggs, and you wonder how this makes sense. Because a lot of people feel squeezed right now. Rent is up, insurance is up, everything at the checkout is up. Yet the parking lot looks like a car show. So today we're going to solve that puzzle in a practical way. How are regular people signing up for car payments that look like a second rent payment? What's happening in the financing system that makes a $60,000 vehicle feel doable in the moment? And most important, how do you avoid a car decision that quietly drags your finances for the next several years? Welcome back to Liam Invests. Let's break it down with clear math, simple language, and real-world steps you can use the next time you're tempted by a shiny new set of keys. First, let's set the scene. A car used to be a big purchase, yet it usually stayed within a certain range. Today, the sticker prices are higher, and the loans are built to stretch those prices into a monthly number that feels survivable. People often shop by payment. Dealers are set up to sell by payment. Lenders are happy to approve by payment. That one habit is the center of the whole story. And here's what that means. When the main goal becomes get the payment down, almost anything can be made to look affordable for a moment. The cost doesn't vanish. It spreads out. It hides in interest. It hides in extra years. It hides in trade-in debt. It hides in insurance. And it shows up later when you try to change cars, move, or build savings. Let's talk about what huge payment even looks like now. A lot of buyers are sitting in the $700 to $900 range on a new car, and trucks and SUVs can push far past that. Plenty of households have two payments at the same time. Add insurance, gas, and maintenance, and the monthly transportation bill can rival housing for some people. That sounds extreme, yet it happens one signature at a time, with the same script. What payment are you trying to be at? So how do people get there? The biggest tool is the loan term. Years ago, 36 months and 48 months were common. Now you'll see 72 months, 84 months, sometimes longer. Extending the term lowers the payment, so the vehicle moves from no way to maybe. The buyer feels relief. The dealer closes the deal. The lender books the loan. Everyone wins in the short run. Let's make that concrete with an easy example. Say a vehicle is $48,000 out the door. If you finance that over 48 months, the payment might be high enough to trigger real discomfort. If you finance it over 84 months, the payment drops a lot. Many buyers stop thinking right there. They feel like they solved the problem. Yet the trade is brutal. You're committing to a payment for 7 years. Your life changes a lot in 7 years. Jobs change, rent changes, kids happen, health happens, moves happen. The payment stays. There's another issue that comes with long terms: depreciation. Depreciation is the drop in a car's value over time. New cars tend to lose value fast in the early years. So if you have a long loan, your loan balance can stay high while the car's value falls. That gap matters because it creates a trap. Here's what that means in plain words. You can owe more than the car is worth. When that happens, you can't sell the car and break even. You can't trade it without bringing cash to the table. You're locked in unless you add debt to escape. And that leads us to the second tool, the trade-in cycle. A lot of people switch cars every few years. That habit worked better when loans were shorter and prices were lower. Now with long terms, many buyers reach year 3 or year 4 still owing a lot. The dealer offers a solution. They roll the remaining debt into the next loan. Rolling debt means you take the unpaid amount from the old loan and add it to the new loan. You drive away in a newer vehicle, and your monthly payment might still look fine because the term resets to 7 years again. The old debt keeps following you. It turns into a hidden surcharge inside the new loan. This cycle is one of the main reasons the numbers seem to defy reality. The buyer sees one payment. The balance contains multiple car decisions stacked together. Now let's talk about interest rates and promotions, because they shape the payment too. You might see offers like low APR for qualified buyers. Sometimes you'll see 0% promotions. Those deals can be real for people with strong credit, yet there's always a catch somewhere in the deal structure. The discount may be smaller. The term may be shorter. The price may be firmer. The bigger point is simple. Focusing only on APR misses the full cost picture. A PR is the interest rate. It determines how much extra you pay on top of the amount financed. Even a few percentage points matters a lot when the loan is large and long. A $45,000 loan at a higher APR over 84 months can add thousands and thousands in interest. And if you already rolled old debt into it, you're paying interest on yesterday's car too. This is also where credit scores come in. Your credit score is basically a risk grade. Higher scores often qualify for better rates. Lower scores often bring higher rates. That gap can take a reasonable purchase and turn it into a heavy payment very fast. Two people can buy the same car at the same price and end up in totally different financial situations because of rate differences. Now we need to talk about the part people forget. The total monthly cost is bigger than the loan payment. Insurance is the first surprise. Insurance pricing changes based on the car's value, the cost to repair it, theft risk, your location, your driving record, and a bunch of other factors. Newer, more expensive vehicles typically cost more to insure. If you finance, your lender will usually require full coverage, which raises the premium. For some drivers, insurance alone can be $150, $250, $350 a month, sometimes more. And if a household has two newer vehicles, it stacks quickly. Gas is next. Bigger vehicles often use more fuel. Even a modest difference in miles per gallon adds up over a year. Then you have tires, brakes, oil changes, and repairs. Modern cars can be amazing, and repairs can be expensive. Technology features are great until something breaks outside warranty. So what happens when the payment is already high and life happens? People get creative in ways that hurt them later. They put repairs on credit cards. They skip building an emergency fund. They pause retirement contributions. They delay paying down other debt. Some people take on side gigs just to support the vehicle. And that's the core issue. Transportation starts controlling the budget. Now let's do the part most people avoid, the full cost math. I'll keep it simple. Imagine someone buys a $52,000 SUV. They put little down, and they finance most of it for 84 months. Their payment lands around the point where it feels manageable, so they move forward. Now layer in the real costs. Insurance might be $250. Gas might be $250 to $400, depending on commute and prices. Maintenance might average $100 to $200 a month over time if you spread it out. All of a sudden, the car payment is not the number you thought. Transportation becomes a four-figure monthly line item for a lot of households. Then comes opportunity cost. Opportunity cost means what your money could have done instead. If $600 or $800 a month goes to a vehicle, that money is unavailable for other goals. It can't build an emergency fund. It can't max a Roth IRA. It can't increase your 401k contributions. It can't reduce credit card interest. It can't go toward a down payment on a home. Those trade-offs are real. Let's keep this practical. Many people get a 401k match at work. A match is free money tied to your contributions. If a big car payment causes you to miss that match, the car is consuming today's cash and tomorrow's growth. Over time, that can be a huge difference. So what should you do with all this? I want to give you a clean, usable plan. This is the part to save. Step 1. Define affordability in a way that protects your life. A simple rule is to keep total transportation costs within a reasonable slice of take-home pay. People argue about the exact percentage, yet the concept matters more than the perfect number. If your car payment, plus insurance, plus fuel, is eating a quarter of your take-home pay, you've basically made your car a major financial priority, whether you intended to or not. A lot of households feel stable when transportation stays closer to the 10% to 15% range of take-home pay. That leaves room for savings, food, rent, health costs, and surprises. If your number is higher, you may still make it work, yet you're reducing margin. Margin is the breathing room that keeps small problems from turning into debt. Step 2. Stop shopping by monthly payment. Shop by total price and total cost. When a salesperson asks, "What payment do you want?" you can answer with something like, "I'm focused on the out-the-door price." Out-the-door price means the full cost including taxes and fees. That's the number that matters because it controls everything else. Monthly payment is easy to manipulate. Price is harder to hide. Step 3. Get pre-approved before you walk into a dealership. Pre-approval means a bank or credit union offers you a loan rate and amount based on your credit. It gives you a baseline. It limits surprises. It prevents the dealership from steering you into a worse rate without you noticing. The dealership can still compete for your financing, yet you'll have a reference point. Step 4. Keep the loan term short enough that your life stays flexible. A shorter loan usually means a higher payment, which forces a more affordable car choice. That's a good thing. Many financially stable buyers aim for 48 to 60 months. If that pushes the payment outside your comfort zone, that's feedback that the car is too expensive for the plan. Step 5. Bring a real down payment and protect your equity. A down payment reduces the amount you finance. It can also keep you from going upside down. It's common to see people put very little down and get trapped when values drop. Even a few $1,000s can change the early years of the loan. If you're trading in a vehicle, check if you have negative equity. Negative equity means you owe more than the car is worth. If you roll that into a new loan, your new car starts out behind. When you start behind, it's easier to stay behind. Step 6. Get insurance quotes before you buy. This is a fast step that saves a lot of regret. Call your insurer or use online quotes with the exact vehicle. If the insurance jumps by $150 a month, that changes the deal. Many people discover this too late. Step 7. Consider the lightly used sweet spot. Used cars can be priced high in certain markets, yet the idea still holds. Paying for the steepest part of depreciation is expensive. A vehicle that's 2 or 3 years old can still feel modern, still have safety features, and often costs less than a brand new version. It can also reduce insurance costs. It can reduce the amount financed. It can reduce the term you need. Step 8. Build the boring foundation first. Emergency fund, high-interest debt, retirement contributions. When those pieces are in place, you get options. Options reduce stress. Options help you negotiate. Options keep you from needing a car loan that stretches across most of a decade. Now let's address the emotional side, because it's real in the US. Cars are status. Cars are identity. Cars are comfort. Cars can feel like a reward for hard work. There's nothing wrong with enjoying a nice vehicle. The problem shows up when the vehicle forces constant trade-offs, month after month. Here's a simple test you can use. If the car payment makes you delay savings, carry credit card balances, or avoid basic goals, the car has moved from a preference to a constraint. Constraints feel normal until you try to change your life. And if you already have a big payment, I want to give you a calm path forward. First, get clarity. Write down your loan balance, your interest rate, your monthly payment, your insurance, and your average gas cost. Look at the full number. That removes the fog. Second, build a small buffer. Even $500 to $1,000 in an emergency fund helps. Car expenses have a habit of showing up at the worst time. Third, avoid rolling debt into the next car. If you're upside down, focus on paying extra principal if possible. Principal is the amount you borrowed. Paying extra principal reduces the balance faster and helps you reach a point where you can sell or trade without dragging debt forward. Fourth, if refinancing makes sense, explore it carefully. Refinancing means replacing your current loan with a new one, ideally at a lower rate or better terms. It can reduce interest cost. It can also stretch the term and keep you trapped if done the wrong way. Keep the goal clear. Reduce total cost and increase flexibility. Fifth, plan your exit timeline. Many people feel stuck because they don't see a path. A written plan changes that. In 18 months, I want to be above water on this loan. In 24 months, I want to have a down payment ready. Small targets help you reclaim control. Now let's tie the whole story together. The reason huge car payments have become common has a lot to do with how the system is designed. Long loan terms lower the monthly number. Trade-in debt can be buried inside the next deal. People focus on payment, and everything else gets pushed into the background. Insurance, fuel, repairs, depreciation, and missed investing all add up quietly. Many households can make the payment and still feel broke because the payment is eating the margin that used to create progress. You don't need a perfect strategy, you need a clear one. A car should help your life run smoothly. It should leave room for the future. And a quick reminder as we wrap up. This is educational content, not financial advice. Make decisions that match your income, your goals, and your risk comfort. If this helped you see the car payment puzzle more clearly, subscribe to Liam Invests, tap like, and watch more videos here to learn more about personal finance, investing, and building wealth the simple way.